Afternoon. This is Jonny Haycock von Greyerz. It's my pleasure in this extraordinary summer of heat to have another discussion, another Gold Matters discussion with our advisor, Alasdair Macleod. Welcome back to another Gold Matters discussion, Alasdair. Thank you for joining me.
It's very much my pleasure. Thank you for having me, Jonny.
I think we're going to, as usual, we're going to try to keep this to 20 to 25 minutes. And I was reading your latest note this morning called The Expectations Gap. And you summarize well the sort of laundry list of distortions that we can all observe in the world at the moment. And there is so much going on. I mean, just in my head, I think about rising geopolitical risk, rising bond yields. We've got the AI trade unraveling. We've got, if there was sort of one image of the euphoria in tech, we've got SpaceX now trading well below issue price. We've got political risk here in the UK, the 7th Prime Minister in 10 years. That feels more like a banana republic than a G7 powerhouse. But then we have FX intervention, and I think that is the real story at the moment, FX intervention and the bond market. So there's a lot there, but in your usual brilliant way, I'd love you just to unpack a little bit, perhaps the key elements that investors might be missing and should be aware of.
Yeah. Well, where do we start? I think as a general comment, I would say that markets are so mispriced. I mean, more mispriced than I have ever seen in the, 56 years I've been in the finance industry. We have this extraordinary situation, Jonny, where there is this war raging in the Middle East. Any objective observer will realize that America has got itself into really difficult problems over Iran, the Straits of Hormuz, and now, of course, the straits at the lower end of the Red Sea, which is cutting out a further, up to 7 million barrels a day. And this is beginning to alarm central bankers and, the treasury ministers and all the rest of it, particularly in the G7. And they talk to each other all the time. They are now very definitely worried, and there's signs of this worry creeping out. Yet markets are incredibly complacent. I think markets have been they've just bought into the propaganda, particularly the American propaganda, hook, line, and sinker. I mean, how many times has President Trump said, we're going to talk peace with Iran? I think someone counted up to 20 times. Only for the next day to find that he's saying, I'm going to bomb the bastards or whatever. And so the market goes up, goes down, but it just moves sideways, and it doesn't actually sort of think, what the hell is going on? The result is what I called in this article the expectations gap. Now, with markets so mispriced against the reality of what's coming, higher prices, if you like, because oil feeds into absolutely every price, if not directly, indirectly through logistics. We are going to see far higher consumer prices later on this year. And that's not just the Gulf as well. I mean, in Europe, we've got a real crisis in food building up with the driest summer in decades, maybe even a century. And the result is that crop yields are less than half of what they normally are, or half what was expected. You've got farmers are feeding their livestock on their winter supplies, so there's going to be nothing left for them in the winter. That's going to drive up beef, lamb prices and all the rest of it. And then Russia closes off Ukraine from the Black Sea. And remember that the Ukraine was Europe's breadbasket. Now, I think they still export a lot of grain, but no more because they've got no ports to do it from. So, food prices are going to be a real crisis. Oil prices, oil derivative prices and all the rest of it. And I think it was probably the Houthis closing off the Red Sea and bombing the facilities at Yanbu that has really sort of woken everybody up within the if you like, the sort of the central banking and treasury, and the insider network right at the top. But we're just still believing the propaganda. I mean, it is extraordinary, and the result is the most massive mispricing. I mean, the surveys in America.
Where exactly should we find the biggest mispricings in your view?
Well, I think the fundamental mispricing is obviously in the bond markets.
Yeah.
Because what do bonds do? They reflect forward expectations of changes in the purchasing power of the currencies of that bond. I mean, that's the main thing. There are other factors, obviously. Now, if we're going to get a fall in the purchasing power of currencies as a result of this fracas in the Middle East, then obviously we're going to get higher bond yields. And the consequences of that are very far-reaching. I mean, you've got all the G7 governments basically are running into a brick wall in terms of their finances. They cannot really issue any more debt credibly for the very simple reason that they're now in debt traps. And their debt is not going to be subscribed to by, first of all, foreign investors, and then secondly, domestic investors as well. They're going to look at this and say, no. I think domestic investors will be lent on. They always are. But it's the foreign element which I think is the margin, gives you the marginal pricing. Once you see the 10-year Treasury go above this 5% level, it's currently, 4.6 or something, having backed off from 4.7, 4.75. Once it goes through that, then I think real alarm bells are going to be ringing. And it won't just be bonds at that stage. The valuation disparity, which you were referring to off camera, between equities and bonds is at the highest level probably in history. And I think we can probably demonstrate this with a chart.
Yes.
The point about that is that if you get another lurch higher in bond yields, the equity market is toast. And not only is the US equity market toast, but it's floating in a sea of credit, which between hedge funds and broker loans, you're looking at around about $9 trillion. So we can see foreigners getting out of that market as well. And how much have they got? Nearly 25 trillion invested in US equities. So you're going to get foreigners liquidating, you're going to get the banks liquidating their collateral against those loans in a falling market. I mean, this could be extremely unpleasant. And following on from that, what do the central banks do? Well, I mean, they have to do what they can to stop the private sector sliding into a slump and markets, if you like, reflecting that. So they are going to expand the amount of credit, which basically means printing currency, printing bank reserves by issuing short-term debt, actually. I mean, because nobody's going to buy the long-term stuff. So they will suppress interest rates in order to just do that. And what happens then? Well, the currencies go down. And we're looking really, I think, and I've been maintaining this for some time, Jonny, we're looking actually at the end of this current fiat currency era. Yeah. Fiat currency eras always end as a result of excessive government obligations.
Yeah, and look, there's a lot to unpack there. I think that the real story is the bond market. All assets get priced, don't they, really off the 10-year US Treasury. Yep. And we talk about sort of this your expectations gap and these massive distortions in the market at the moment. But what's quite clear in the bond market is that G7 yields are now 20-year highs. Yep. Japanese government bond yields are at 30-year highs. So the bond market is absolutely waking up, and they're rather like sort of the magician that sort of tries to, distract you with one hand over here and not showing what's going on over there. What I do think is really important that I'd love you to comment on is this intervention that we've seen in currency markets, both by Japan and by the US, which I suspect most investors are absolutely not aware of, but it's actually very, very rare. But I think that gives you an indication of the stress that the central bankers absolutely feel. Could you summarize what's going on there, Alasdair?
Yeah, sure. I mean, basically, we had Besant and his opposite number in the finance ministry in Japan, if you like, triggering the most massive bear squeeze in a collapsing yen currency. And it moved it from something like 100, I can't remember the figures, 166 or 163, I think it was, 164 down to 157. I mean, it's upside down, The low number is a strong yen and vice versa. I mean, the whole object of the exercise was to relieve the pressure on Japanese institutions, holders of US treasuries, relieve the pressure on them to sell. That was the whole point. And what Besant was doing is he wasn't actually selling dollars to buy yen. He was selling euros to buy yen, which is interesting, if you like. I don't know that it's that significant. But you're right, because this is a panic move. Of that, there is absolutely no doubt. I mean, we now have a situation where we know for absolutely sure Japan is in one hell of a mess. And when I say that 90% of her oil and LNG comes from the Gulf, you can understand why she's in such a mess. And the last time this happened, actually, back in 73, her inflation rate, believe it or not, at consumer price level, went up to 25 to 30%. We are 1.57, I think, is the latest number I have, which is a heavily massaged number, let's face it. But you can see how far this is likely to go. And with debt to GDP taking in government itself and a little bit extra, you're looking at 250% debt to GDP. They cannot afford higher interest rates. I mean, back in 73, they were 20% debt to GDP. Now they're over 10 times that. So this is an absolute toxic mix. You've got bond yields rising, you've got very high debt to GDP ratios, and you quite clearly what drove the finance ministry to push its pension funds publicly, and also, I mean, by implication, the insurance companies as well, to invest more in Japanese yen, is that the Bank of Japan can't actually take any more on its books. And so where does it go? So that's the first one. The second one now is we have Besant admitting he's got a funding problem by his actions in the foreign exchange markets. But I mean, we know this because if you look at China back in February told its banks, in effect, sell your US treasuries because, the wording was sell your excess US treasuries because we think they're too volatile. Which
two of the largest holders of US treasuries have basically stopped buying and become sellers. So that's China and Japan. And maybe in its most simple form, Alasdair, we bond yields are rising because there simply isn't enough demand at the rates that these governments can afford. Simple as that. And we focused on Japan there. Look, the US is in a hell of a pickle, isn't it? Because interest expense on their debt and then you add in their entitlements now equates to 100% of tax receipts.
Yeah.
That's before you go into recession. My colleague Matthew Piepenberg was telling me the other day that the US is now paying $3 billion a day on just the interest on the debt. Yeah. I mean, these are just mind-blowing numbers. Let me repeat that: $3 billion a day just to service the interest on the debt. I mean, it's just crazy numbers. So, and with debt to GDP at 125% in the States now, 6% deficit and widening. I do think, to your point, these mispricings and massive distortions, which I think the bond market clearly is waking up to in G7 nations, but the stock market hasn't yet. Which let's come back to the stock market, and the chart that we've shown earlier, showing the mismatch between the valuation of the S&P and the long bond yield. That gap has never been wider. We all know that stock markets are in a bubble. They've been driven by the tech AI trade, a wonderful narrative that it is, but it does appear that there are cracks here, and the amount of debt that these massive companies are now taking on, and I was very intrigued to see the announcement that Nvidia was now providing financing guarantees of $250 billion, which was 2/3 of the cost of the chips that it's selling to OpenAI for their Ohio data center. So you've got this circular financing. Well, we've seen vendor financing before. We know how that can end, right? It doesn't tend to end well at a time where the stock market's at 42 times Schiller PE. So there's just no wiggle room at all for stock markets as and when, to your point, if yields are getting to that point where something breaks.
Well, you're right. And, if we're looking at high tech, there's now a great shortage of helium, which is required in the processing of these chips. So the cost of processing chips is going to rise enormously, and I think there's going to be a huge shortage. So, it's all sort of top of cycle type stuff. When you get sort of shortages of this, shortages of that, and suddenly, prices are rising again to the point about prices as a whole. And then what happens? Well, bond yields have to rise. I mean, whichever way you look at it, that is the way it's going. And the bubble in equities is absolutely enormous. I mean, these are things that are self-perpetuating. It's always very dangerous to try and call the exact top. I mean, I remember a conversation with an investment manager back in 2000 when we had the dot-com bubble. And, we agreed it was a bubble. But his point was, well, look, there's no point in me chasing value propositions because they underperform. You just have to ride the bubble while you can and just hope that you get out before any damage is done. And they're all doing that. And they realize it. I mean, your point about the Schiller PE, 40 and all the rest of it, this isn't secret. This is widely known. So, despite that, everybody's keeping the myth going. That's the point about a bubble. It's that, somebody else is going to buy this stock off me at a higher price. That's what I believe. I don't need to believe anything else. And they're not looking at anything else. Yeah. And of course, this is inevitable.
You remind me of the great, the great or sad Tony Dye story at, what was it, March 2000, the great value fund manager that finally lost his job at the peak of the dot-com bubble. And I'm sure we're going to see the same again. But let's move on to gold and silver, Alasdair. Because look, our clients are wealth preservationists, and our clients understand that the end game here is actually quite simple to understand, and that is that we just have to look at history, and history shows that when countries get as indebted as the US is, the UK is, as France is, as Japan is, at some point, can't forecast it, they'll have to print more money, they'll have to inflate away the debt, there'll be yield curve control, and devalue the currencies. And that's of course what the end game is here. And it's very interesting to me that we've had this correction in gold and silver. In part, it's just a normal correction in a secular bull market, but perhaps the size of it has surprised investors, and at a time of chaos in the Middle East, sure. But I think it's happened, Alasdair, because the last 2 to 3 years has been all about the great debasement trade.
Yeah.
And I suspect that over the last few months, markets have started to question that great debasement trade. But if history is right, that the only way out of this is to print more money to save the bond market at the expense of the currency, then that great debasement trade is back on. And
vengeance. With a vengeance.
yeah, and as we talk today, it's who knows, but it's quite
Yeah.
interesting to see that you've got gold and silver prices certainly seem to be firming up here, and may have found the lows. Who knows? But it's interesting that those two markets are now starting to wake up to the distortions that you talk about.
Yes, I mean, what we've seen, Jonny, is we've seen all the sort of the froth, if you like, just taken out of the market, and everything that I've been seeing in the last few weeks tells me that the market is just so oversold. I don't think there's any speculative froth in there. I wouldn't mind betting that along with the swap, say, on COMEX and so on, there are shorts out there who are being squeezed the morning this is being recorded, which is the 5th. And silver is up 4%. I mean, it smells, if you like an initial short squeeze. Yeah. But I want to come back to the fact that markets are so mispriced. And it's not just bonds, it's not just equities, but we're looking at the relationship between fiat currencies and gold and silver as well. And I think your comment about the debasement trade is absolutely spot on. The other thing that people don't understand is that gold and to a lesser extent silver, but still technically silver, are real money without counterparty risk. Yeah. They only really come into their own when there is risk in credit. Currencies are credit, and that risk is demonstrably increasing. And I think anyone who finds that hard to understand should actually just sort of think about what the hell is really going on in the world. What is happening to all this debt? What is going to be the consequence of higher bond yields? What's that going to do to the risk of owning any form of credit? If you can understand that, then you'll understand why get the hell out of credit and get into real money, which is only gold without counterparty risk. So this is the debasement trade, which I think, again, as you describe it, I think is going to come back for much of the future. I think in terms of, I mean, whether gold goes to 6,000, 8,000, I don't particularly care. It's not gold going up. It's currencies going down. This is the point which, of course, nobody really understands because they all account in their currencies. I mean, they've been thinking that gold is a risk. So, actually my risk-free position is just to hold dollars cash, for example. Well, yeah, the accountant would agree with you, but it doesn't take account of the depreciation in the value of that risk-free asset. But gold does. Yeah. Gold's purchasing power is relatively constant over long periods of time. I mean, you can go and look at Diocletian's Edict of Maximum Prices, and you will find things in there which are similarly priced today. Slave markets have gone, thank goodness, so you can't compare them. But there are other actually quite serious day-to-day things which you look at the prices and they are not too dissimilar to those of similar qualities today. And this is terribly important to understand because nowhere is this more true than in the relationship between gold and commodities. Yeah. So what we are seeing is the beginning of a decent commodity bull market measured in declining fiat. But really, this is all an escape from fiat currencies. Yeah. And the idea that an individual commodity is driven by supply and demand factors is undoubtedly true. But if you look at a basket of commodities, that basket's value reflects, if you like, the other side of the value of the currency in which you're pricing it. Yeah. So these are going to be very interesting times. The dollar debasement trade is going to give you quite a few exit points, I think, out of dollars, euros, yen, whatever the currency is. But the principal one and the accepted one is gold, which is why central banks are selling fiat to buy gold. They're not buying gold so much as they're selling fiat.
Well, it's interesting. We talk about, how the distortions are out there, the mispricings are enormous today, and sentiment towards gold and silver at these levels is at extreme lows. We all know that people like to buy high and they like to sell at the lows. But what is interesting, Alasdair, of course, is there is one whale in the room who has continued to stack gold month in, month out, and that's China. And they're just waving it in every month, waving it in. It's no mystery to them how this unfolds in coming years. And that's very, very notable to me.
Yeah, and not only that, I mean, we won't go into the whole history. I mean, it's take us a couple of hours of great fun, I have to admit. But suffice to say that China's moves to be able to put its yuan onto a gold standard have been accelerating, particularly from April the 2nd last year, when Trump held up his board with all the tariffs and all the rest of it. You know, you see everything that they were doing was to protect their currency. Now, they're not going to suddenly, say, right, this is the rate we're going to go on the gold standard and, to hell with the rest of the world, because they don't want to be blamed for collapsing the rest of the world. That blame, as far as they're concerned, and certainly as far as I'm concerned, is right in the court of the Americans. I think what the Chinese will do is they will wait until it is absolutely obvious that our problems are down to our follies, if you like, in the G7, America's in particular, because that happens to be the one which we see now. But, we're all committers of the same sin. And once that is obvious, then I think China will protect herself to put her yuan onto a gold standard.
Yeah.
Originally, I thought this would be just for trade settlement purposes through her SIP system. But I'm more inclining to the view that it's going to be wider than that. And I think it will also encompass the domestic yuan. And I think that exchange controls will probably be removed at that stage. The reason that I think this is because the People's Bank no longer requires for you to seek its permission if you want to export gold from China to Hong Kong. In other words, the gates have been opened. That, I think, is a major, major, major move. And it just does indicate what China's real thinking is.
Absolutely. And look, in the interest of time, let's wrap it up there, because I think that the China evolution and their intentions in gold and everything we're seeing in Hong Kong with the clearing system is absolutely fascinating, and is the biggest telltale sign of all about where they see the future going, gold's role in the next monetary system. But listen, let's pause it there. Thank you so much for unpacking a complex laundry list of risks. But look, from my point of view and from Greyerz, we love having you as an advisor. Keep up the good work with your writing. And look, I think we'll look back in 6 months or a year from now and see these prices in gold and silver as very, very depressed indeed, and is a wonderful buying opportunity. So thank you, Alasdair. Let's do this again in the next few weeks.
Let's do it soon. Yeah.
Right. Bye-bye.
Thanks very much, Jonny. Bye.